Hi, I'm Iain Pyle, the manager of Shires Income Trust. And this week we're looking forward to the UK election. And it's always a question of how much portfolio managers think about elections, how important they are to our process. And the trust has been around for almost 100 years. It's lived through many, many elections, and it will live through many more. So we try not to get too focused on short-term political events, and we try and invest through more than just the next political cycle. But it is very true that a UK election sets the government for the next 5 years, and that does have a meaningful impact on the economic environment, the fiscal policy, and other things which will definitely impact the returns from companies domiciled in the UK over that period. And even with a long-term view, 5 years is a meaningful time horizon for us in our investments. So an election is something we think about closely, and it's an important consideration in how we invest. So I think when we come into an election, we really think about it in three stages. And the first thing to think about is really how long you have to prepare for that election. And most you have a number of months, maybe quite a long time to get used to the election, to understand the policies of the potential governments and make a decision on what that means for the portfolio. You do have other instances, like the French election last week, where they're a bit of a surprise, and realistically you can't do much with a portfolio to change it in that period of time. But if we think about the UK election, we've had a well-flagged date set out, although it was a bit earlier than people expected. And we've known the main parties and their rough policies for some period of time. So there is time there to think about what we need to do in the portfolio, to understand what's happening, and to take action if we feel the need. The next thing is really to dig into what the parties are saying and what the likely outcome is. And even though you have to wait until quite late in the day to get detailed manifestos, you can read the sound bites and policy statements from both parties for some time before. You know roughly where they will sit on the political spectrum and what that might mean for various sectors. Once you have a view on that, it's really a case of trying to decide what the most likely outcome is and whether that is priced in by the market. And I think that could be much more volatile. This time, maybe it isn't. And generally, because the market is very good at pricing in information early on, it's hard to have much of an edge on the outcome as a fund manager. So the decisions you make are probably more about risk control as they are about taking a proactive stance. And just making sure that if there is an outcome, you're not going to be doing too much damage to the portfolio from being on the wrong side of it. Generally, when we think about the implications for what a election result might mean, they tend to be quite nuanced at a sectoral level. You can have some clear outcomes. For example, in US elections, you would usually say a Democrat government is worse for the healthcare sector and a Republican government is better for energy, for example. Those kind of things are, pretty standard in the playbook, so you can position for that. In the UK, it's not quite so well defined as to what a government means for various sectors. Last time around, you had a very pro-nationalist Labour Party, quite keen on taking control of some regulated industries, and that would have been a big concern for utilities, for example. So you would have taken a view on those sectors. And the biggest, I think, clear division I can remember is coming into the Brexit referendum in 2016, where the market's perception was very much that a yes vote was negative for the UK economy and sterling, and therefore, if you believed the UK was going to leave the European Union, you would want to be positioned long international companies and short domestic companies. Not many people thought that was going to happen, and it turned out to be quite a painful event for money fund managers in the day. But generally, you're not going to get such a clear shift from one way to the other. Maybe that brings us on to the election this week. And the UK election this week is a slightly unusual one, I think, because the outcome is very well anticipated in that all the polling and all the odds would point you towards a Labour government and likely a fairly sizable Labour majority. So that means the margin for error here is perhaps lower, and you're probably not going to get a big swing from the market on the day of the results unless there is something that is a big surprise, i.e. a Conservative government. But if that happens, it will be the status quo continuing. So again, the shift and the margin for error there is not that high. Coming into that, and probably adding to the lack of jeopardy in this election for the markets, Labour policies have been very careful not to spook the market, I think. They have been careful to avoid the kind of mentions of nationalisation, bank taxes, major changes to tax policy or corporate tax that would make investors wary of the Labour government. It's been a pro-growth, market-friendly agenda that they've set out. So it's unlikely that if we do get a large Labour majority, we're going to see that as a negative event for the UK. And then post-results, we've got a bit of a period of time to actually wait and see the detail, because although we've had manifestos, there's actually not that much detail for what Labour policies might be, and we're likely to have to wait until the next budget, which will probably come in the autumn of this year after the Office for Budget Responsibility have had a chance to look at Labour's policies. So there's a bit of a hiatus in terms of the detail and the impact on UK markets coming through. So I don't expect big reactions. And I actually think the most meaningful impact will be that we get through an election, there's probably a government with a sizable majority, and there's political clarity for the next 5 years and a degree of stability, particularly compared to other regions of the world, which means there's a good chance of the UK being seen as a more stable market, being seen as a more reliable place to put capital, and hopefully closing that valuation gap we currently see in UK markets to the rest of the world. And then it's also worth remembering, I think, that once we get through the UK election, we're then into the next round of the French elections, and then we're into the US election at the end of the year. And those ones are equally, if not more meaningful for our portfolio and for markets, particularly the US election. So we'll be thinking about those ones next.